ENT202. In today's tutorial happens to be the continuation of the course ENT202. With this being said, let's go straight into it. So we apologize for having to start this late. It's a lot with the network back end, but we just have to do something. So today we're taking it up from investment decision, and by the grace of God, this week we should be done with this course, and by next week we are taking some other course entirely. Now, when we say investment decision, what are we talking about? Investment decision is concerned with the allocation of capital. Concerned with the allocation of what? Capital. Is concerned with the allocation of capital. Now, don't forget, when you talk about investment, you are talking about some good capital. All right? Investment is more or less of capital deferred. All right? Capital kept aside. All right? It's totally different from you saving your money in the bank. Now, it is a decision whereby it's a decision where cash is committed into a meaningful and profitable project. All right? A decision whereby cash is committed into what? A meaningful and a profitable project. Now, when we talk about investment, there are types. So what are the types of investment? We have the cost reduction investments. This investment is made in order to reduce costs. Cost E, all right? Cost reduction investments. Revenue increasing investments. This is what? The expansion. All right. This takes form of plant expansion to produce a greater output. Revenue increment. We also have imposed investment, as these, all right, may be the cost increasing without any direct compulsory revenue. All right. Cost might increase when it comes to imposed investment, but doesn't necessarily, all right, translate to the increments in revenue. So what are the method of investment appraisals? All right, there are basically three different approaches to investment appraisals. When we say investment appraisals, they are what we call the classical approach, the modern portfolio theory, and the capital asset principle model. Now, when we say the classical approach, we are simply talking about the investment decision that could be made with every degree of uncertainty. All right? Classical. There's degree of what we call, there's a high level. All right? High level of uncertainty. All right? That is the classical approach model. Then we also have the modern portfolio and capital asset pricing. It is considered, all right? This model considers risks in their analysis. That is the capital assets, all right? Capital asset pricing model. This considers risks, unlike the classical approach to investment. All right. We've talked about the classical, we talked about the modern. Now, the classical approach of investment analysis can be broadly categorized into two different categories. The subcategory under the classical. These are non-discounted cash flow and also the discounted cash flow. All right. We have non-discounted cash flow, and we also have the discounted cash flow. Now, when we say non-discounted cash flow, what are we talking about? This is the investment technique, all right, which, all right, the investment has no consideration for time value of money, all right, no time value, all right, of money. Then we also have, all right, the discounted cash flow method. These are the investment analysis, all right, that takes into consideration the time value of money, all right. That time, value of money. So we have that as that. So very quickly, let's touch on accounting assumptions and principles. What are the accounting assumptions and principles? So to mention but a few, all right, let's start with single entry. When we say single entry, what are we talking about? All right, single entry. We are simply referring to, all right, the fact that the business and the owner should be seen as two different bodies. Single entry. All right. In accounting, the business and the owner, they are seen as two different bodies. So in reporting accounting information, the business firm should be separated from the owner. We also have call periodic. We also have what we call um, units of measurements. All right. Accounting information is reported in monetary units. So the monetary unit should be considered. All right. The monetary unit should be current. Now, when we say unit of measurement, we're simply talking about reporting accounting, all right, information in monetary units. Okay. So we also have the um, durability, which is the principle that states that every financial transaction should be recorded in double entry. For every debit entry, there must be a corresponding credit entry. That is a principle I believe we all understand by now. Okay, so we have that as that. So also we have the classification of accounts. Okay, now financial transactions are classified into different accounts in their recording. Okay, this personal account and we have the impersonal account. So under the class, we have personal accounts, and we have impersonal accounts. Now, under personal accounts, we have these are accounts of individuals and firms having dealings with a business. All right, account of individuals and a firm having dealing. All right, individuals slash firm having dealing with a business. While the impersonal account is said to be account of people, the account which take care of other items of business other than debtors and all right, um, debtors and creditor. The impersonal accounts are subcategory into what real accounts and nominal accounts. All right, this is more concentrated on individuals. All right, here we have more or less individuals. They are accounts that take other items of business. All right. Other items of business other than debtors and creditors. They are not account of people. All right. This is the account of people. So we also have under this in personal accounts, we have the real account. All right. And we also have the nominal account. The real account is the account of assets of a business, such as building. All right. Real accounts. We have assets as account of assets of a business, such as building, machinery, vehicles, land, stock. And we also have the nominal account. Now, this nominal account is simply talking about, all right, the account is, all right, the category for revenue of a business, talking about wage, rent, salary. Nominal account, talking about the revenue of a business. So we have that as that. So now, let's take it off. Let's talk about the books of accounting. All right, books of accounting. So we're going to mention but a few. We have the purchase journal. All right, the purchase journal. When we say purchase journal, we are simply talking about books of accounting that are used to record credit purchases. All right, used to record credit purchases only. Okay, and we have the general journal. Journal is a right into the journal. All right, all cannot be registered into the journal. All right. So we have quite a list of them, but just can't take just few. We have the petty cash book. All right. When we say petty cash book, it's used for recording minor cash expenses. So it's quite unfortunate that we cannot go this, we can't go much, we can't go far in today's class because it will infringe to take away the time left for other classes. It's quite unfortunate that the network questions are on our site today. Could have started earlier if it wasn't because of the terrible network. So we apologize for that and promise that in our subsequent class we would experience better network, all right, situation whereby we can take enough time and explain things properly. Do have a wonderful evening and bye for now.